Here. So Dan the Wise is here. So hello, Dan.
Hi,
Welcome
Dan.
back. So today we are going to talk about rent or buy.
Rent
But
or buy.
before I start jumping into the topic, so I'm going to introduce Matthias Richter and myself. So if you are watching this for the very first time, then you know who we are, why we are doing this. So this is Fast Track Money weekly YouTube live session. So I'm Yasi. I'm behind the Fast Track podcast, and the Fast Track content is a content platform. And then now here I have Matthias Richter. He is financial Imagineer.
Hi, everyone.
Financial Imagineer is a blog and a website to bring very useful content to help people make their dreams come true. That's why it's, how to say,
Imagineer.
Yeah.
Engineer your imaginations.
And then we are doing this weekly on Wednesday night. We talk about everything about money to help you to understand how to use it as a tool to fulfill your dreams. And in the past sessions, we have covered about money habits, what is investment, like debunking the myth, investing myth, and other small topics. And then today, we are going to focus on the, let's say, century-long debate, buy or rent. It's not so straightforward for some people, and it also depends on where you are right now. And there are also different factors, associated with these two scenarios. So today we are going to talk about it. Then you will have a better understanding. Should we rent or should you buy? Which one is better off? So let me start asking you a first question, Matthias.
Oh, yeah. Which one?
Do you rent or do you buy?
I bought. I used to be a renter when I was younger and when my life needed to be more flexible. But I think once you have kids or once you settle down in certain places, it becomes better eventually to buy. So maybe the very quick answer to the whole century-old question is it depends. Rent or buy, it depends. Okay, show is over, bye, everyone. No, of course not, right? So no, we have drilled very deep into this topic, and in the next 25 minutes or so, we shall elaborate, share some stories, and like Yasu mentioned, it also depends where you live. So we have lived in Taiwan, Singapore, and Switzerland, and we still commute back and forth between the places. Different countries have different kind of cultural habits, or like how they look at how do you live. In certain places, it's not even, or almost like socially not acceptable to get married if you don't have a house. So it depends. And also in Switzerland, it's very, very safe to rent because the renters are protected, and you have very good laws, whereby in other places it's more like a free market economy. And if you are renting from someone, then probably, well, your landlord can decide a lot of things. So probably he can go up with his rent after 1 year. And so it depends on the location, it depends on your lifestyle, it depends on your age, on your family. There's so many factors. And I think today, right, Yasa, we have brainstormed about that, and we can dig a little bit into all these different aspects. And hopefully, if you are watching this today with us, you feel free to ask us some questions as well. So the comments are open. Yasa and me, we see the live comments from your side. So yeah, hi Portugal reviews. Nice to have you back. So yeah, it should be an interactive session as well. And sometimes we will stop probably and just ask to see if there's any questions. But no need to wait. Just shoot the questions if you have any.
Yeah, exactly. And now you mentioned that you used to be a renter because it's more flexible. You live in a flexible lifestyle, and now you own homes. So
Yes.
exactly for me, I'm renting because I need the flexibility. And I guess it's the reasons are more than just flexibility, right? And there could be financial reasons behind it. So let me ask you first question, like what are the financial reasons that pro for buying?
For buying, okay. Number one, you actually one thing that you need to have before you buy is you need to have some capital. You cannot just buy without any cash. So it is something that becomes part of your wealth building process eventually. And if you have saved up some money, you unlock this option to potentially buy real estate. If you have done that, financial reason number two, you can get eventually a mortgage, so which allows you to get leverage on your wealth. Number three, you get tax advantages, which you don't have as a renter. Number four, you unlock like if you buy real estate, usually it appreciates over time. It has been like that. It's like an inflation protected asset in most parts. And as long, maybe the last 100 plus years were special. We had a lot of economic advances, and population was growing. So all these things helped that real estate becomes more expensive. Whether or not that continues to be like that, we will see. So definitely, if you own an asset, if you live in it yourself, of course, it's self-occupied, but you can also convert the house that you buy and rent it out. So it can become like a dividend stock, or it can become a cash cow for you, which is in certain ways you can look at it like a fixed income instrument, like a bond, that actually can appreciate. So it has, and you unlock the leverage part because the bank will be able to give you a mortgage. So financially, there's a lot of things that make it interesting to buy. But like we said before, you have to settle. You have to know where to buy, and that's a whole new story behind that as well.
So to summarize, I think it's the financial side is pretty obvious that you can leverage the loan is like a leverage, and then when the property appreciates, you actually have unrealized gain. And
Yes.
also on the other hand, not the financial side is also more stable because it's
Hmm.
your own place. You will not be like informed by your landlord, oh, I have sold the apartment, please move out. Or like, oh no, I don't want to rent it to you anymore, please move out. This is I guess nobody wants that. So I think on the
Yeah.
emotional side, it feels secure to have your own home.
I mean, in some places, even when before the rental contract is due, you're still living in that house. Maybe you have to renew your contract every year or every 2 years. And sometimes, if you are the renter, the landlord might just send in some potential new tenants to check how you react, right? So that could be quite a, like Singapore is a place like that. And
Yep.
it could be a tactic how to raise the rent for you. Hey, we have a question from the art of money saving. I just see. Is there an easy way to calculate the costs between buying a home and renting for the long term? An online calculator. Yeah, I think, yeah, we have some resources for that. There's, because it's a very complex matter, for that question, you have to look at a lot of things. So maybe we come to that later. Buying a house, the costs are not just so straightforward. So easy, I don't think it's easy to calculate, because if you buy a house, it's not just your mortgage and the taxes. There might be things like you have to upkeep your property, which means you have to set aside some money, you have to renovate it eventually. Maybe the toilets are broken, right? And you have to fix them. The kitchen breaks down, you have to fix it. You may have to do some gardening work. The roof is broke, any kind of thing, or it needs a new paint job. It all depends on these things. So easy, no, but if you just want to simplify for the monetary part, there are a lot of calculators online. I think we will share that in the comments later.
But
I have
it's
seen
also,
something.
I think this is a little bit tricky because in each country you have different like taxes.
Yeah.
And then, for example, in Switzerland, there's one thing that shocked me. shocked me is that for a homeowner,
Mhm.
if you own a home, the local like tax office or someone from the government, they will evaluate how much rental income would you have if you were rented your apartment out. But
Yeah.
obviously you are living there yourself, right? You're not renting out, but this is like assumed income for you, and then
Yes.
it's going to be added to your total yearly income, then you're going to pay income tax for it.
Hmm.
That for
Well,
me it's really shocking.
Singapore has the same thing. They just call it differently. They call it property tax. And I know in the US, state by state, they also have a property tax, which is calculated also with the value or the market value of your property. In Singapore, they look at your property and they also calculate what could you have earned. And then based on that, you have to pay a property tax. And it's lower if you live in there yourself. It's higher if you rent it out. And Switzerland has no property tax. Actually, we have an asset tax, but then with real estate, if you combine it with mortgage, the asset tax could get negative. You don't get money back from the government, but the housing value will be calculated very interestingly, to say that. And yeah, it's very interesting. It's not so straightforward, and every location you have to consider the tax aspect. I mean, I have to say that like after 2011, there was like the European financial crisis, right? And there were some countries in southern part of Europe. I think Spain was one of the countries that got very badly hit by the euro crisis, not just Greece. And in Spain, they actually tried to attract a lot of Chinese capital by selling them a piece of real estate together with a ID, right? And later, because of the Chinese that came, they started to make the real estate prices go higher. The locals could almost not afford real estate anymore. So, like within 2-3 years, they had to adjust again the tax laws to kind of penalize the foreigners that bought the place. And then, well, the tax aspect will be a whole different game because the government can change these tax rules anytime, and you cannot move your house away. So if you don't like the tax rules, your house will still be there, and eventually it will get very quickly much harder to sell it or rent it, or it gets more expensive, and it will turn all your finances upside down. Oh yeah,
Mm.
Portugal reviews made a combination here. Spain, Portugal, and Greece. Yeah, the gold visa for Portugal, exactly. So you could actually, I don't understand exactly. Yeah, okay, he say 500,000 euros, I suppose, that you have to invest
Yeah.
and get a house, and then you get, as a foreigner from anywhere, you can actually reside, get your domicile card, and because you buy the real estate, it's like your foot into living there, and you unlock a new permit. So if you're a foreigner with 500,000, you want to have an EU ID. This is one way you can do it instead of just buying a passport or something.
And next week on Tuesday, I'm going to release exactly an episode with Nomad Capitalist on this topic, being a global
Oh yes.
citizen, living in different countries with multiple citizenships, and reduce your tax rate to 1%. That's how he did it, like from 34% to 1%, just by geo arbitrage. So, okay, I
Mhm.
don't want to sidetrack, but let's
Yeah.
come back to.
I'm
So,
looking forward to that episode. Congratulations again for getting the Nomad Capitalist on your show. That's awesome. Can't wait to listen to it.
yeah.
Yeah.
So
Okay.
for
So
renting, it's pretty straightforward, right? And so for renting, the financial impact is your monthly rent. You don't get anything back from that. But
much more controllable. Yeah, you can
yeah.
make, if you rent, you just know how much you've got to pay. I think sometimes you have like side costs, probably the heating costs or air condition costs and so on, but that's about it. So it's very predictable, and you know exactly if you are young, you may go abroad again. It's flexible, you can cancel, you can move, and you don't have to worry too much. If something breaks down, like kitchen, toilets, and so on, you simply call your landlord, and it's not your problem. So
Yeah. I
it's a
think
different.
like both of us have this problem with tenants in properties abroad, and then
No,
some.
no, it's The tenants are good. My tenants are very,
Oh, the
very good.
apartment
Yes,
renovate or
yeah, the
maintenance
apartment
cost. Yeah,
apartment sometimes things happen, right?
unpredictable.
And then
Yeah.
yeah, you have to take care. And if you see that the apartment price is appreciating, it doesn't mean you get cash for that. So it's a you may be asset rich but not cash rich, for that's how to say it, right? And then you cannot simply go back to the bank and say, oh, because my house is worth much more now, I want to have a higher loan. You have to go through the whole process again.
But you
But
can, right? But if, for example, if you
of
own a
course,
property and your property price goes up, then you can go to the bank and ask
yes,
for cash
yes.
out to have more loan. Then you can use the cash to buy a second property or invest in something else.
Exactly, exactly. That's how it works as well. But then you have to go through the process again from the start, and that's also something I think it's very good. You cannot do that as a renter. So if you rent, let's say you have to pay 1,000 per month in rent, and if you have a mortgage, you can go to check out different banks. Maybe they have different interest rates, different conditions, and who knows? If you shop around, you can actually push your costs down and
Mm.
increase your cash flow. There's a lot of things you can unlock with that.
In general, what if someone will live in one city that this person foresees that, okay, in the next 5 to 7 years, living in one place? In general, if the person has the amount of cash for a down payment, would it better to buy or would it better to continue renting?
Then a next set of questions comes in, because if you buy a property, it's nothing else than buying access to proximity of like the potential of earning an income, convenience, and the tax domicile. These are usually the things. And if you say your city has very good business and you think the next 5 years the business is still okay, there's more people moving in, you have a growing population, the tax regime will not change too much, I think it looks attractive. But if you are in a place where people are leaving, some places have like something called like a brain drain. The young people are moving away. There's just old people. The taxes are going up because the social costs are increasing. Then maybe the same setup like you just described can be very different depending on that city where you are. So it also depends there. But then if you say I'm going to stay there, the other thing becomes important is to foresee the economic future of that place and then make a judgment call, right? And of course, if you say 5 7 years you will stay there, the next question is, okay, what do you think is this place going to be worth in 20 years and 30 years? You go really, really for the long run,
This
because
place, you mean this property that you intend to buy?
eventually, yes,
Oh, okay.
because if you have economic cycles that can take, I think the shortest one I've seen was 2 years, and the longest one probably 13 years. We're still in an uptrend somehow, despite all the COVID crisis. But yeah, we have recession. But if you look at the stock markets, it's somehow decoupled at the moment. But since 2008-9, it was just up, 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 right?
Yeah.
And sometimes these cycles take only 2 years. Sometimes it can be more than a decade. And if you just have 5 7 years as your time frame, I think it's not long enough to make a well-informed decision. You have to have a longer time frame, I would say.
So you say like 5 to 7 years is not enough long to make a decision to buy
In
or not buy?
in most places, no. Yeah, I would say it's not long enough. Unless you have a plan for afterwards. If you say this place, I believe in it for a decade or two, then go ahead and buy. But if you don't know what happens 5 7 years later, if you buy it at the wrong point and you have a downtrend, the economic cycle turns against you, then I don't know if you want to sell it if you still get your money back that you
Mm,
invested, right? So that's the
yeah.
uncertainty.
And right now the interest rate is so low, it somehow drives up the property price. It's
Exactly,
pretty
yeah.
they were bought so fast, so on the market a day later it's gone.
In Denmark, 2 years ago in Denmark, you could get out a mortgage and they will pay you to get the money out. So you actually get paid 0.5% interest if you take out a mortgage. So let's say you buy a house for 1 million. And let's just assume for simplicity, right? You take out 1 million mortgage, they will pay you 5,000 per year or 500 per month because you borrow that money. And the money is so cheap, so it's abundant. And if that money all goes into some places, you see that we have like an inflation of asset prices. Maybe shares go up because this money ultimately has to go somewhere. And if it's parked in real estate, then the prices rise, right?
I also want to mention the other thing about the down payment. For example, if there's for example, people, someone or a couple have the money for down payment, but they do not invest them. They put them in like close to 0% interest rate bank account.
Yes.
Then in this case, they are not activating their savings.
Mm-hmm. Yeah.
Maybe it's better that they buy a property because then they are investing in an asset which can
Mm-hmm.
appreciate in 10 years time.
Yeah. There you go back into risk profiling. So how much risk are you willing to take? If you are a more like a risk taker, you can say, I rather like to rent the house and I put all my excess cash into ETFs and like funds, equity funds, and you can assume that they should rise faster than your property. But if you are more conservative and you don't even dare to put your cash into an ETF or something, you probably will feel better and sleep better if that money is invested in a house. I think that's clearly a difference there. And also, like we mentioned at the beginning, for some cultures, different cultures in the East, it's like a necessity almost to have the security of a home rather than just renting. So it's really like, where do you see yourself on this risk scale?
Okay. So so the like say conclusion I get from your side is if someone is going to live somewhere for long period of time, do not think of moving abroad or moving to
Hmm.
another economic area, then in long term the cycle of the real estate, like the risk is lower than
Yes.
living there for short term.
Sure, yeah, and the longer time frame you have, the more a no-brainer it becomes to just buy something, of
Yeah.
course, right? And if you are the more insecure you are about your own life design, I think the more the economic factors of this place where you plan or not plan to buy will play a role, and then you have to look at it more like an investment.
Mm.
And
Once I also heard this theory of buying a property is like you are hedging for your old years, like your retirement, because then you
yes.
don't have to, when you stop having income, then you still have a place to live. So at least that saves a lot of cost from renting.
Yes, and there's even more than that. So if you have a house in the UK, for instance, you can have a negative mortgage. So what is a negative mortgage? So I start in a place like Switzerland, for instance. Let's say you retire, you have still a mortgage outstanding. The bank will come and see your retirement income. And if your retirement income is not sufficient to justify the mortgage, you are running the risk to actually the bank will come and claim the house back because you
Yeah.
still have a mortgage. So that's one risk. But in the UK, exactly for that matter, they came up with reverse mortgages, the reverse or negative mortgage. That means when you are at your retirement age, you can go to the bank and say, hey, bank, here is my house. I pledge it back to you. The house is yours, but now instead I have to pay you for the mortgage. You have to pay me some money. And of course, for people who are like scared of the economic ups and downs, this could be an interesting thing. But of course, the bank earns money on that, and your kids will not get anything of your house because the worst case could be you pass away 2 years after you retire, then the house is gone because it's like a life insurance kind of setup. But if you live until 120 years, the bank will lose. So you have you have very very innovative setups there to hedge for like this long life risk or to hedge for uncertainties and all these things. which could be quite awesome. And of course, if you have a big house, and your kids are leaving the place, you could also like make like an extra apartment inside your house, or two units or 3 units out of one, and then rent out two of them, live in one yourself. And then there's so many ways how you can activate your assets. So real estate is much more than just four walls and the roof. It can become something you can really play along and activate it for
Activate. I
you.
like the word
Yes,
activate.
activate your assets. Yeah.
Yeah, not just a home for you to sleep every day, but also you can activate the asset and make it working for you.
Yeah. And then, of course, over time, because the bank is eager to give you a loan or a mortgage, you have a leveraged effect that very oftentimes helps you to multiply your wealth. That's why a lot of elder people, they talk about how good is real estate. If you ask them, it's an inflation protection. So if, let's say you have a house, it's a real value. If your government decides your money is not worth anything anymore, or adds a couple of zeros to every bank bill, then you still have a house. So you don't care about that. You're happy because you have a real asset. More like on the other side, if you have a house, you have, like I mentioned, you have to factor in the maintenance, the upworks. You have interest rate risks. So money was not always as cheap as it is right now. In the early 1980s in the US and Canada, I have seen some people, they talk about interest rates on a mortgage of 15 or close to 20%. This has happened before. I'm not sure where we are heading, but just imagine you have a big outstanding loan, and interest rates go up like that. It would be crazy. It could break some of these basic assumptions if you plan for the long run, right?
Exactly.
So have a margin of safety there as well.
And then tying it back to what you mentioned in the previous sessions is, do not buy too much house.
Yes.
That's a big risk, right?
Well, it's a preference, right? If you have a lot of assets and you have a big income, you can afford a house, but it doesn't mean you have to buy a big house. But in the US, they call it the Mac mansions, these huge homes, and then people even have invented the term you are house poor, or like you have a big house but you have to pay for it. And the word mortgage, I think I've mentioned it on this show before, it comes from French. Mort means to die, and the gitch is the pledge. So a mortgage is nothing else than a death pledge. So the word mortgage comes from signing up your life to the bank that they give you a big amount of money to buy a house.
But the interest rate risk is something that I think people should not neglect, because it's quite, the impact is huge. Like, imagine if you are buying, like someone is buying too much house based on the current interest rate, the current earning capability, and then 5 years or 7 years later, they need to have another mortgage, and then the interest rate is, let's say, doubled or increased by 1%. Then your monthly payment is much more than what you have like used to in the past.
Correct. In some places you can hedge for that, right? I think with options you can do a lot, but it costs something because it's some kind of insurance. In Switzerland, I think the longest you can hedge is 10 years. 10 years mortgages at the moment are just around 1%, maybe even below if you're lucky with negotiation, which is super cheap. But what if you have that for 10 years, you don't prepare anything, and then in the 11th year, the new rate is 5%, right? Then you may be derailed again, and that will have an impact on the property price as well. So
and then would you recommend that for someone who is going to get a mortgage, it's always better to get as long as possible with like a reasonable difference compared to?
Yes. One thing is if you can have, at the moment, I like the flexible mortgages because I simply don't see yet that interest rates will go up. But that's my personal view. And if you want to have planning security, or like some places you cannot get an interest-only mortgage. So I was just talking about interest-only mortgage. But if you get a mortgage where you have to pay back the principal, my biggest advice is get it as long as possible. Get a 30-year or 35-year mortgage. Maybe some people say no, that's too long and whatever, but it doesn't mean it has to take you 35 years. If you have extra cash, you can actually pay back earlier, but you don't have to. So if, let's say, you lose your job, you have less cash a few years down the road, and you have a 15-year mortgage and you're pushed into paying back very much very quickly, you may have financial problems because of that. And if you have the long-term mortgage, if you have extra cash, nobody tells you cannot change it back, right? So you have more flexibility, and you can also renegotiate every once in a while. So 35 years fixed today doesn't mean like 5 years later you cannot go back to the bank and change it.
Oh, really? Like you sign 35 years mortgage, you can still go back to the bank and then
Yes.
have another mortgage?
Yes, depending on conditions, you can actually change it because you can get out of the contract, depending on the contract you get.
Okay, so there are still certain degree of flexibility.
Yes. So
Okay.
if you, before you sign that thing, because it's a death pledge, make sure you have some options in there. Yeah.
I once I did a comparison with my friends in the US. They were looking for buying a house. I mean, the price they are paying for a house is ridiculously lower than in Switzerland, but the size of the house is ridiculously much bigger. But what's
Yes.
interesting is that, I mean, that's a couple of years ago. So, for example, there are 500,000 house versus in Switzerland 1 million apartment. The monthly payment is the same because
Yes.
the interest rate is so much lower in Switzerland.
Yes.
I mean,
Yeah,
slightly
correct.
lower, but then then it's the same monthly payment. Yeah.
Yeah, and if you go to Hong Kong is super crowded, right? You will be happy to have a shoebox. So that's another thing. And
Portugal review said the construction quality is pretty bad in the US.
well, I think it also depends what you buy, but you get what you pay for, right? So I think with real estate, you also get a piece of land, which is good. That's valuable. And then you get what is on top of that land. And if the construction quality is poor, you have to actually depreciate that part faster. And the house I'm currently living in is 50 years old, but it still feels quite okay. So in the US, you see sometimes when hurricanes come, it's not windproof. But let's go to Taiwan, for instance. If in Taiwan you have a big typhoon coming, it feels very safe. It's even like earthquake proof. So it really depends what kind of steel they use and how much material they can construct into your house, put into your house.
But I have to say, I'm very impressed by how old some houses are here in Switzerland. They are still standing very stable on the land. So in that sense, I
Built to
guess we pay for
last.
the quality. Yeah.
Built to last.
Mm-hmm. And now we are coming to the close of this session.
Yes, that was a very fast half an hour. Damn. Any questions from the audience that we didn't cover? Feel free to write any questions. And we talk too much. It's already 30 minutes.
The art of money saving was asking for like a calculation template. I did myself, but it's based on the Swiss market. What I find interesting is that there's always people saying, "Oh, you save tax from your interest, but then you have to pay additional like assumed income, and then there's always deduct money from you or putting money back to your pocket." I think the best solution is really to calculate in your own situation. Like then you really see which one is better. Because there are so many variations of plus and
the life
minus.
plan. Start with your life plan and start with your emotions and your risk preference. I mean, these are the key things. Some people have this dream house. I think then it's clearly has a different priority than someone that has the dream to go travel all the time, or somebody So every life is different. There's no right or wrong. And like I said at the beginning, it depends, right? So buy if you're ready to settle, but and buy also if it makes sense as an investment if you're not sure whether you settle or not.
But the biggest lesson I took away from today is given that all the factors I have already, taken into consideration myself, that is really to factor in the interest rate risk. Because
Yes,
5 and 10 years down the road, if the interest rate is so much higher than today, you might be screwed up. So it's important to think about that.
exactly. Yeah. Nothing is forever. Yep. Also, low interest rates might change again.
Mm-hmm.
Currencies might change, right? So currencies might get reformed. There might be a new currency coming. And I've seen cases in countries, go back to Taiwan, they had an old Taiwan dollar. And then suddenly they added, I think, 4 zeros overnight, and then they had a new Taiwan dollar. And if you actually had outstanding debt before in the old Taiwan dollar, it cost a bomb because the inflation was high. That's why they have the new Taiwan dollar. But if you had this outstanding debt balance, you actually win a lot, because when they change this currency, you're like on the same side like the central banks, and that's something I think is interesting at the moment, because there's so much debt out there. If you are aligned with the central banks, it could actually pay out eventually. But we have to see how this continues.
Okay, I haven't seen any questions from the audience,
Yes.
so please go to check out our website down in the description. There will be a lot of useful articles from my website and from Matthias' website, and every Tuesday there will be new Fast Track podcast episode to be released. And the next Tuesday is exactly talking about a global citizen and what are the benefits you get from it. Yeah, nomad capitalist, exactly. So, but multiple citizenship, having properties overseas, reduce your income tax, everything that might be related to what we are discussing about. We have a pop-up question.
Yeah, question is, does it make sense to invest in real estate outside of Switzerland? Yes, it makes sense. It also depends. It's an investment case. If you say invest, make it an investment case. Look at the upsides, the downsides, the yield, all that. Look at the currencies. See if it makes sense. It could also make sense as a retirement plan, and say use the profit to pay your rent in Switzerland. Yes, that could be a thing, right? There's places where, like if you have a place in Hong Kong that you rent out, or in New York City or something like that, you can easily use that to pay here. But you could also turn it around. If, let's say, one day you want to retire in Portugal, or you want to retire in Thailand, and you have a property in Switzerland, you can actually have somebody renting your place here and send the monthly paycheck to you in wherever you are, right? And then you have like steady cash flow, and your assets are working for you.
It's like a bond, like income investment.
Correct. Yes.
Okay, great. Then let's wrap it up.
Next week we will talk about buying or leasing again, but not a house. Next week we talk about cars, right, Yasu?
Yeah, it's also a very interesting topic. There are different opinions, and then I also see like a very smart people having lots of cash, but they prefer leasing. They're like a different choices. So we're going to talk about it next week, and happy to have you guys back next Wednesday, same time. And
cars are more depreciating, real estate more appreciating. So it will be very different. Yep. Sorry.
Okay, then that's it for today. Bye-bye.
Cool. Thank you for joining, guys. See you next week. Bye.